Let me tell you something straight, because the market has no patience for polite lies. Trading to make money is not about clever tricks or fancy talk. It's about seeing what price is doing, understanding why it's doing it, and having the discipline to act only when the odds are on your side. That's it. Everything else is noise. You can dress it up any way you like, but when you sit in front of a chart, you're facing the same thing I faced years ago, a battle between your mind and the tape. You might think trading is about predicting the future, but that's not how money is made. It's made by following the present. Price tells the truth long before any headline does. If a stock is rising on heavy volume, that's not an accident. If it's slipping lower day after day, that's not bad luck. The market is speaking. The only real question is, are you listening, or are you arguing with it? I've always said the big money isn't in the buying or the selling, it's in the waiting. You wait for the market to tip its hand. You wait for a stock to break out of a long base. You wait for volume to confirm what price is trying to do. And most of all, you wait for your own emotions to settle down. Because if you rush in just to feel busy, you're not trading. You're gambling. And you don't need a chart to gamble, do you? A trader who wants to make money must first learn how not to lose it. That sounds simple, but it's the hardest lesson there is. Every chart has a place where you're wrong. Your job is to know that place before you enter the trade. If price moves against you beyond that point, you step aside without complaint. No excuses, no hoping, just a clean exit. Why? Because your capital is your ammunition, and a man who wastes his ammunition doesn't last long in a fight. When I look at a chart, I'm not trying to be clever. I'm looking for strength. I want to see higher highs and higher lows. I want to see volume expanding as price moves up. That tells me money is flowing in, and money doesn't flow in by accident. Big operators leave footprints, and price is where those footprints show up. Don't you think it makes sense to follow the footprints instead of guessing where they might go? Too many traders spend their time hunting for secrets. They think there's some magic indicator or hidden pattern that will unlock easy profits. But the market doesn't reward secrets. It rewards understanding. A trend that's been rising for weeks is not a mystery. It's a statement. It's saying buyers are willing to pay higher prices. Your job is not to argue with that. It's to go along with it while it lasts. Now, I've seen more money lost by stubbornness than by bad analysis. A man will buy a stock, and when it starts to fall, instead of admitting he was wrong, he tells himself a story. He says it's just a pullback, or the market doesn't understand the company, or tomorrow it will turn. But the chart is already telling him the truth. The stock is going down. Why should you stay on a sinking ship just because you boarded it earlier? Making money in trading is really about controlling yourself. The market will always do what it wants. You can't change that. But you can decide how much you risk when you enter and when you leave. That's where your power is. And if you misuse that power by overtrading, by chasing price, by refusing to cut losses, the market will teach you a lesson you won't forget. I used to watch stocks all day, not because I wanted excitement, but because I wanted to understand their rhythm. Every stock has one. Some move slow and steady, others jump and pause, but they all leave clues. You see it in the way price reacts to resistance. You see it in how it holds above support. These are not abstract ideas, they're practical tools. They tell you where buyers step in and where sellers take over. Wouldn't you rather trade with that knowledge than against it? A trader who makes money is not someone who's right all the time. He's someone who loses small when he's wrong and wins bigger when he's right. That's the whole game. You don't need a high percentage of winning trades. You need a sensible relationship between risk and reward. If you risk $1 to make 3, you can be wrong more often than you're right and still come out ahead. Doesn't that sound more realistic than trying to be perfect? The chart is like a ledger of human behavior. Fear, greed, hope, and regret are all written in those bars and candles. When price shoots up too fast, that's excitement. When it stalls at the top, that's hesitation. When it breaks down, that's fear taking over. If you learn to read those signs, You're not just trading lines on a screen, you're trading the crowd. And the crowd, as a rule, is usually late. One of the biggest mistakes traders make is trading too much. They think activity equals progress. But in the market, patience pays better than action. The best trades often come after long periods of doing nothing. You wait for a stock to tighten up, to build energy, and then you act when it breaks free. That's not boring. That's disciplined. And discipline is what keeps you in the game long enough to let compounding do its work. Wealth in trading doesn't come from one big score. It comes from many well-managed trades stacked on top of each other. Each one follows the same rules. Enter with the trend, risk a small amount, let profits run, cut losses quickly. Over time, those small edges add up. It's not exciting, but it's effective. And in this business, effectiveness beats excitement every time, doesn't it? You have to respect risk if you want to stay solvent. Every trade carries uncertainty. The market doesn't owe you anything just because you found a nice-looking pattern. That's why position sizing matters. If one trade can ruin you, you're trading too big. A professional thinks in terms of survival first, profits second. Because once you're out of the game, there are no more opportunities to catch the next trend. I've always believed that a man's biggest enemy in trading is himself. His impatience makes him enter too early. His fear makes him exit too soon. His ego makes him hold on too long. The chart is neutral. It just reports what's happening, but your mind adds all the drama. If you can quiet that down and just follow the price, you give yourself a real chance to succeed. And when you do get into a good trade, when the trend starts to move in your favor, that's when you need the most discipline. It's tempting to grab a quick profit and walk away, but the big money comes from sitting tight while the market does the heavy lifting. You let the winners grow. You don't interfere just because you're nervous. After all, if you cut your profits short, how do you expect to cover your losses? So every day you sit down in front of those charts, you're making a choice. Are you going to trade based on what you hope will happen, or on what price is actually doing? Are you going to respect risk, or ignore it? Are you going to wait for the right setup, or chase whatever is moving just to feel involved? Those questions matter more than any indicator you could ever add to your screen, and if you think about them honestly, you'll start to see that trading to make money is really about aligning yourself with the market instead of trying to outsmart it. Price action is the market's true voice, because everything that matters eventually shows up in the movement of price itself. All the opinions, all the news, all the rumors and forecasts get filtered through one simple thing: what people are actually willing to pay or accept at any given moment. When you look at a chart, you are not just seeing lines and bars, you are seeing decisions being made by thousands of traders, institutions, and investors all at once. That collective decision-making is what moves the market, not what anyone says about it afterward. If you want to know what the market thinks, you don't need to read a headline. You need to look at price. A stock can have the best story in the world, but if price is not moving up, the story doesn't matter. The market may not agree with it, or it may simply not care yet. Price is honest in a way that opinions are not. It shows you where money is flowing and where it is leaving. When price pushes higher and holds those gains, it tells you buyers are in control. When it breaks lower and cannot recover, it tells you sellers are stronger. Everything else is just commentary layered on top of that basic truth. Many traders get distracted by too much information. They load their screens with indicators, news feeds, and predictions from other people. But all of that can pull their attention away from what is right in front of them. Price already reflects all known information. If a company reports good earnings, you will see it in price. If bad news is coming, price often starts to weaken before the headline hits. That is not magic, it is just the reality that some participants always act earlier than others, and their actions move the market. When you focus on price action, you stop trying to guess what should happen and start paying attention to what is happening. That shift changes everything. Instead of arguing with the market, you begin to listen to it. If a stock keeps making higher highs and higher lows, It is telling you demand is stronger than supply. If it keeps failing at the same level, it is telling you sellers are waiting there. These patterns are not abstract ideas. They are real behaviors repeating over time. Support and resistance are not just lines drawn on a chart. They are memories of where people previously bought and sold. When price comes back to those areas, traders remember what happened before and they act again. That is why price often reacts there. Watching how price behaves at those levels tells you much more than any indicator ever could. Does it bounce strongly, or does it slip through easily? Each reaction is a sentence in the story the market is telling. Trends are another way price speaks. A trend is simply a series of movements in the same direction, but inside that simple definition is a lot of information. A strong uptrend shows that buyers are consistently willing to step in at higher prices. A weak trend shows hesitation and uncertainty. By reading the slope, the speed, and the pullbacks of a trend, you can tell whether it has strength or whether it is running out of energy. Volume adds another layer to price action. When price moves with heavy volume, it means many participants agree with that move. When it moves on light volume, it can mean the move is fragile. You don't need complex calculations to see this. A breakout with strong volume is a loud voice. A breakout with weak volume is a whisper. Listening to that difference can help you decide which moves are more likely to continue. Candlestick patterns, bar formations, and chart structures are all just different ways of reading the same thing, how price behaved over time. A long upper wick shows rejection of higher prices. A tight range shows balance between buyers and sellers. A sudden expansion shows one side taking control. These are not mystical signals. They are visual records of what happened between supply and demand. When traders rely too much on indicators, they often end up reacting late. Most indicators are built from past price, which means they lag behind what is happening now. Price itself is always current. It is the first place change appears. By the time an indicator confirms a move, a large part of it may already be over. That is why learning to read price directly gives you a clearer and more immediate connection to the market. Price action also helps you manage risk more effectively. When you see where price has failed before, you know where a trade idea stops making sense. That gives you a logical place for a stop. You are not guessing. You are using the market's own behavior as your guide. That keeps your decisions grounded in reality instead of hope. Over time, you start to see that price has a rhythm. It moves, it pauses, it pulls back, and it moves again. Those pauses and pullbacks are just as important as the moves themselves. They show you whether traders are taking profits or whether new buyers are stepping in. A healthy trend often has controlled pullbacks that hold above key levels. When those levels break, it tells you the character of the move may be changing. The more you study price, the more you realize how much it reflects human nature. Fear shows up as sharp drops. Greed shows up as fast spikes. Uncertainty shows up as sideways movement. By reading these expressions in price, you are really reading the psychology of the market. That gives you an edge because you are not just reacting to numbers, you are responding to behavior. When you trust price action, you free yourself from the need to be right about everything else. You don't have to predict economic data or earnings results. You just have to see what price does with that information. If the news is good and price goes up, you stay with it. If the news is good and price goes down, you step aside. The market has already made its judgment. This approach makes trading simpler, but not easier. It takes patience to wait for clear signals. It takes discipline to follow what price is saying, even when it goes against your opinion. But over time, that discipline builds consistency. You stop chasing every idea and start focusing on what the market is actually offering. Price does not lie, but it can be confusing if you don't know what to look for. That is why practice matters. The more charts you study, the more patterns you recognize. You begin to see the difference between a real breakout and a false one, between a healthy pullback and a breakdown. Those distinctions come from experience, not from formulas. As you grow as a trader, you start to feel when price is under pressure and when it is relaxed. You see when a market is coiling up and when it is exhausted. Those subtle changes are part of the market's voice. They tell you when to lean in and when to step back. Price action keeps you honest. It doesn't care what you want to happen. It only shows what is happening. That honesty is what makes it such a powerful guide for anyone trying to trade and build wealth through the markets. You can listen to countless opinions, but only one thing pays you, and that is price. That is why every serious trader eventually comes back to it. That is where the truth always waits. Trends pay, predictions don't, and that idea sits at the center of every successful trading career, whether a trader realizes it or not. The market does not reward the person who guesses the future correctly in a dramatic way. It rewards the person who aligns himself with what is already happening and stays with it, as long as it continues. A trend is simply the market's way of showing direction, and direction is where money is made. When prices are moving steadily higher or lower, they are telling you where demand and supply are leaning, and that is far more important than any personal opinion about what should happen next. Most people come into trading wanting to be right. They want to call the top, pick the bottom, and tell a story about how they saw it all coming. That might feel satisfying, but it is not how consistent profits are built. The market does not pay you for your foresight. It pays you for your alignment. When you trade with a trend, you are working with the flow of money rather than against it. When you try to predict a reversal, you are standing in front of that flow and hoping it will stop for you. A rising trend shows that buyers are willing to pay higher prices over time. That means demand is stronger than supply. As long as that condition remains, the path of least resistance is upward. You do not need to know why it is happening. You only need to see that it is happening. By the time a trend is visible on a chart, it has already passed many tests, and each test has been answered in favor of the same direction. That history gives you something solid to lean on. Predictions, on the other hand, are built on assumptions. They depend on what someone thinks should happen based on news, analysis, or personal belief. The problem is that the market does not have to agree with those beliefs. A company can report strong earnings and still see its stock fall. A bad economic number can come out and the market can rally anyway. When you are trading based on predictions, you are constantly at risk of being blindsided by reality. Trends keep you grounded in what is real. They show you the result of all those conflicting forces playing out. If price is moving up, then despite all the worries and doubts, buyers are still in control. If price is falling, then despite all the optimistic forecasts, sellers are still dominating. By following the trend, you let the market do the thinking for you. There is also a psychological advantage to trading trends. When you are in a trade that is moving in your favor, the market is reinforcing your position. That makes it easier to hold on and let the trade work. When you are trying to pick a turning point, you are immediately under pressure. The trade starts against you, and you have to sit there hoping it will come back. That kind of stress leads to bad decisions, and bad decisions lead to losses. Trends also offer clearer risk management. In an uptrend, you can place your stops below higher lows. In a downtrend, you can place them above lower highs. The structure of the trend gives you logical points where your idea is proven wrong. That keeps your losses small and defined. Predictions do not give you that clarity. If you think a stock should go up because of some forecast, where do you admit you were wrong? Often there is no clear answer, so the loss grows while you wait. The market spends most of its time in trends or in preparation for them. It may move sideways for a while, building energy, but eventually it breaks out and starts moving in a direction. Those are the periods when opportunity is greatest. Traders who are waiting for trends are ready when that happens. Traders who are busy making predictions often miss the move because they are focused on what they thought would happen instead. Another problem with predictions is that they tie your ego to your trades. If you predict something and the market goes the other way, it feels personal. You start to defend your view instead of adjusting to new information. That is dangerous. The market changes its mind whenever it wants, and you have to be willing to change with it. Trends make that easier because they give you objective signals when the direction shifts. A trend does not last forever, but while it lasts, it offers repeated chances to profit. You do not have to catch the exact beginning or the exact end. You only need to catch the middle. That is where most of the movement happens. Trying to pick tops and bottoms is not only harder, it is less rewarding. The middle of a trend is where the market is most comfortable moving, and that comfort shows up as smoother, more predictable price action. Following trends also helps you avoid overtrading. When you are looking for predictions, you are always hunting for the next idea. When you are following trends, you can stay with one move for a long time. That reduces stress and transaction costs. It allows you to focus on managing what you already have instead of constantly searching for something new. Over time, you start to see that trends appear on every time frame. A short-term trader may follow intraday trends. A long-term trader may follow trends that last for months or years. The principle is the same. You identify the direction, you enter in harmony with it, and you exit when it changes. That simplicity is what makes it so powerful. The hardest part is trusting it. Your mind always wants to jump ahead and imagine what might happen. It wants to be clever. But cleverness is not what builds a trading account. Consistency does. And consistency comes from doing the same sensible thing over and over, which in trading means sticking with trends until they show signs of ending. You will sometimes give back a portion of your profits when a trend finally turns. That is part of the deal, but you will also capture far more by staying in the move than you ever could by jumping in and out based on guesses. That is why trends pay. They give you a framework for staying in alignment with the strongest force in the market. Predictions will always be tempting because they promise certainty in an uncertain world, but the market does not offer certainty, it offers probability. Trends tilt those probabilities in your favor. When you accept that, you stop trying to outsmart the market and start letting it work for you. You watch how price moves. You see where it holds. You stay with what is working. Patience creates the best entries because the market is always moving, but good opportunities are not always present. Most of the time price is drifting, chopping, or reacting to short-term noise, and that kind of movement offers very little edge. The trader who understands this does not feel the need to be involved every minute. He waits, not out of laziness, but out of respect for how markets really behave. When you are patient, you allow the market to come to you, instead of chasing after every little move. Many losses come from entering trades that were never really ready. Price might look like it is starting to move, but without structure, volume, or confirmation, it is just a guess. A patient trader waits for the setup to fully form. He waits for the breakout to hold, for the pullback to find support, for the trend to prove it is still intact. That waiting filters out a lot of bad trades before they ever have a chance to hurt him. Charts have a way of testing your nerves. They will often move just enough to make you feel like you are missing something, and then they will stall or reverse. That is how impatient traders get trapped. They see a small move and jump in, only to find out it was just noise. A patient trader understands that real moves have weight behind them. They show strength through price and volume, and they don't disappear the moment you get involved. Patience also helps you get better prices. When you wait for a pullback in an uptrend, instead of buying at the top of a surge, you reduce your risk and improve your reward. You are not trying to be clever, you are simply letting the market breathe before stepping in. That small difference can have a big impact over time. Entering closer to support gives you a clearer place to be wrong and a larger potential upside if the trend resumes. The market often gives you more than one chance. A stock breaks out, pulls back and then continues. Or it consolidates, then breaks out again. Impatient traders rush into the first move and often get shaken out. Patient traders watch how price reacts and step in when the move proves itself. They let others test the water first, and they follow when the path looks safer. There is also a mental side to patience that is just as important. When you are not desperate to trade, you make better decisions. You are not forcing setups that are not there. You are not reacting emotionally to every tick. You are calmly evaluating what you see. That state of mind makes it easier to follow your plan and stick to your rules. Waiting is not passive. You are actively observing. You are watching how price behaves around key levels. You are noting how volume changes. You are seeing whether buyers or sellers are stepping in. All of that information builds a clearer picture. By the time you do take a trade, you have more confidence because you have seen how the market has been acting. Patience also protects you from overtrading. Every trade carries risk, even the good ones. If you trade too often, those risks add up quickly. By being selective, you reduce the number of times you expose yourself to uncertainty. You focus on quality instead of quantity. That approach keeps your account more stable and your mind more focused. Some of the best trades feel boring when you enter them. The chart is quiet, the pattern is tight, and nothing dramatic is happening. But that quiet is often a sign that pressure is building. When the move finally comes, it can be powerful. Impatient traders are usually gone by then, having jumped in and out during the dull part. Patience also helps you avoid chasing. When a stock has already moved a long way in a short time, the risk of a pullback is high. Chasing that move puts you in a weak position. You are buying when others may be ready to sell. A patient trader waits for that pullback or for a new base to form. He would rather miss a trade than enter one with poor odds. Over time, you begin to see how much waiting improves your results. Fewer trades, but better ones. Smaller losses, but larger wins. Less stress, but more consistency. That is the quiet power of patience at work. Markets will always try to rush you. News flashes, sudden spikes, and fast drops all push on your emotions. They make you feel like you have to act now or miss out. Patience is what keeps you from falling for that. It gives you the space to think and the discipline to wait for what really matters. When you let the market show its hand before you act, you are not guessing. You are responding. That is a much stronger position to be in. You see the setup. You wait for it to mature. You take it when it is ready. Risk defines every trade because the moment you click buy or sell, you are stepping into uncertainty. There is no trade, no matter how perfect it looks on a chart, that is guaranteed to work. The market can always move against you, and that possibility is what makes risk the foundation of everything you do. If you don't understand how much you can lose on a trade, then you don't really understand the trade at all. Many people think about profit first. They imagine how much they might make if price goes their way. That is natural, but it is backwards. A professional trader thinks about what happens if he is wrong. He measures the distance between his entry and the point where the trade no longer makes sense. That distance is his risk. Only after he knows that does he think about potential reward. This simple shift in thinking changes the way you approach the market. Risk is what allows you to survive long enough to benefit from your edge. Even the best strategies have losing trades. If those losses are too large, a few bad outcomes can wipe out months or years of work. By keeping risk small and controlled, you give yourself room to be wrong and still stay in the game. That is how consistency is built. Position size is one of the main tools for controlling risk. A trade with a wide stop needs a smaller size. A trade with a tight stop can have a larger size. The goal is not to make every trade the same dollar amount, but to make the risk on each trade fit within your limits. When you do that, no single trade has the power to ruin you. Charts help you define risk in a clear way. Support and resistance, trend lines, and recent highs and lows all give you logical places where a trade would be invalidated. If price breaks those levels, it is telling you that your idea was wrong. By using those points for your stops, you let the market decide when you should be out. That keeps emotion from taking over. Ignoring risk is one of the fastest ways to lose money. When traders move stops, hold losers, or average down, they are usually doing it because they don't want to accept a loss. But a small, planned loss is just part of the business. An unplanned, growing loss is a sign that risk was not respected. The market does not care how you feel about a trade. It only cares about price. Risk also shapes your mindset. When you know exactly how much you can lose, you are calmer. You are not watching every tick with fear. You are not hoping or praying for the market to save you. You have already accepted the worst-case outcome. That frees you to focus on managing the trade instead of worrying about it. Over time, you begin to see that good trading is less about finding amazing opportunities and more about avoiding big mistakes. A trader who avoids large losses has a huge advantage over one who is constantly swinging for the fences. Steady, controlled risk allows your winners to add up while your losers stay small. Risk and reward are always connected. A trade with a small potential profit, but a large risk does not make sense. A trade with a large potential profit and a small risk is what you look for. By comparing these two numbers before you enter, you are stacking the odds in your favor. You are not guessing, you are evaluating. The market will always offer you opportunities, but not all opportunities are equal. Some come with tight, well-defined risk. Others come with wide, uncertain risk. Learning to tell the difference is one of the most important skills a trader can develop. It keeps you from taking trades that look exciting but are actually dangerous. Risk management also helps you stay emotionally balanced. Big swings in your account can make you reckless or fearful. When you keep risk steady, your equity curve is smoother